For centuries, gold has been seen as the symbol of stability. Heavy, rare, almost indestructible. Unlike paper or digital numbers, gold cannot simply be created. It has to be discovered, mined, and refined. Because of this, many societies began to see gold as a natural form of money. But as economies grew, carrying gold became impractical. So something new appeared. Banknotes. At first, these notes were not just paper. They were a promise. A promise that the holder could exchange the note for a fixed amount of gold. This system became known as the gold standard. By the late 19th and early 20th century, it became the foundation of the global financial system. Countries fixed the value of their currencies to gold. If a nation had more gold, it could issue more money. If its gold reserves declined, the money supply had to shrink. In theory, this created discipline. Governments could not simply print money. Inflation remained low. And international trade became more predictable. But every system comes with a cost. The gold standard made money stable. But it made economies rigid. When economies grow, they need more money. But if the supply of gold does not grow at the same pace, problems begin to appear. Money becomes scarce. Deflation begins. Prices fall. Debts become heavier. Businesses collapse. And economies contract. This happened repeatedly in the late 19th century. But the real tension appeared during crises. Wars. Financial panics. Severe economic downturns. In those moments, governments needed flexibility. They needed the ability to create money quickly to stabilize their economies. But the gold standard did not allow it. During the First World War, many countries temporarily abandoned it. After the war, they tried to restore the system. But the world had already changed. In the 1930s, the global economy collapsed into the Great Depression. Unemployment exploded. Production collapsed. And many economists began to see the gold standard not as a solution, but as a constraint. Countries that abandoned it earlier often recovered faster. Those that defended it the longest suffered the deepest crises. After the Second World War, a new monetary system was created. It was known as the Bretton Woods system. In this system, the United States dollar was linked to gold. And other currencies were linked to the dollar. For a time, the system worked. But even this arrangement could not last forever. In 1971, the President of the United States, Richard Nixon, ended the convertibility of the United States dollar into gold. This event became known as the Nixon Shock. With that decision, the era of the gold standard effectively came to an end. From that moment on, the world entered a new monetary age. An age of fiat money. Money not backed by gold. Money backed by trust. Trust in governments. Trust in central banks. Trust in the financial system itself. But trust can be fragile. And whenever that trust begins to crack, people often return to something much older. Gold. Because in a world of expanding debt and endlessly created money, gold still appears to represent something real. Something solid. Something permanent. And that leaves us with an important question. Was the gold standard truly a system of stability? Or was it simply the illusion of stability? History rarely moves in straight lines. But the systems that shape money, shape the world.